Two retired couples can have the exact same income and pay very different amounts of tax. Not because one saved more, not because one worked harder, and not because the CRA plays favorites. Sometimes it comes down to one simple detail that can have a huge impact on your tax bill. And that's the part many retirees miss. Tax planning in retirement is not just about how much income you have. It's about how that income shows up across the household. I want to show you why the same income doesn't always mean the same tax bill, how income splitting can help reduce tax, and why some of the biggest planning opportunities show up during major life transitions. Now, one of the biggest mistakes we see is people looking at retirement income one piece at a time. They look at one pension, one parcel of land, one investment account, one RIF, one spouse. But retirement tax planning does not work well when you look at everything with blinders on. Because while most couples think in terms of the household, what the total amount that's coming in is, CRA actually taxes people individually. That seemingly slight difference is crucial, and it means two couples with the same total household income can end up with very different after-tax results, depending on how that income is divided and reported. Here's a simple example. Let's say one couple has $180,000, but most of it lands on the husband's tax return. The husband gets a big fat tax bill each and every spring, and the wife has little to no taxes owing. Now, look at another couple with the exact same $180,000. Except theirs is spread more evenly between the husband and wife, each reporting $90,000 of income. Same money coming in, same household income. Very different tax outcome. Why? Because when too much income stacks up on one tax return, more of it gets pushed into those higher tax brackets. And in some cases, that can also affect things like your credits or your clawbacks. This is not just an accounting exercise to appease Revenue Canada. This can have a real impact on how much money you get to keep in your pocket and get to spend, simply because you were thoughtful in your retirement planning and utilized those available tax brackets with purpose. So how do you actually do this? Well, I'm glad you asked. Let's dive into a few of the common ways people equalize their incomes. So income splitting sometimes gets talked about like it is some clever tax trick. It's not. It's just planning within the rules so income is taxed more efficiently when that option exists. The basic idea is simple. If one spouse has much more income than the other, you may be missing an opportunity. Goal is not to do anything fancy or shady. The goal is to avoid piling too much income on one person while the other is sitting in those lower tax brackets. One of the more common tools people have heard about is pension income splitting. And at a high level, that can be helpful because certain pension income can be split between spouses for tax purposes. That can make the tax picture a lot more balanced. But pension splitting is only one piece of the puzzle because retirement income usually comes from more than one place. It could be pensions, your RIF withdrawals, non-registered investment income, corporate income, some rental, government benefits like OAS and CPP. Not all of those are treated the same way. That's why proper planning matters. It's not just about asking, can we split this one thing? It's about asking, what does the whole household income picture look like? And this is where things such as old age security can start to come into that conversation. It's tough to have a conversation around retirement planning that doesn't branch off into all the other considerations. And I don't want to get too deep into that in this video, but if you want to dive into old age security further, I'll leave a link down below to a video that we have talking about all things old age security. But at a high level, once income gets high enough, old age security clawback can become part of the problem as well. So for some couples, this is not just about paying a bit more regular tax. It can also mean giving back those benefits that could have been protected with thoughtful planning. Now, Here's the bigger point, and honestly, this is where some of the best planning opportunities tend to show up. It's not usually in the middle of your retirement, years after everything's already set up and paying. It's during those transitions. That's when the biggest wins often happen. Think about the moment you retire. Your income starts changing from employment income to pensions and withdrawals. Think about that year that you're starting your RIF. You're selling your business. Think about changing how assets are held. Think about the shift from active income to investment income or those rental incomes. Those are the points where one or two good decisions can help you for years to come. Or one or two rush decisions can quietly cost you, tax you every single year. This is where farm families should pay close attention. We see it commonly with our ag-based clients. Let's say farmland is owned individually. Later on, that land starts producing rental income. Well, if that rental income lands heavily on one spouse's return, you can end up with way more income concentration than what you really want. But if ownership and structure have been thought through ahead of time, there will be the ability to have future rental income shared a little bit more evenly. Again, not a trick, not a loophole. Just a reminder that tax planning is not something you want to do after the fact if you can help it. We all know the saying, best time to plant a tree was 30 years ago. The next best time's today. So when people ask, how do we pay less tax in retirement? The answer is almost never one magical solution. It's stepping back, zooming out, looking at your entire financial world. Who reports what income? When does that start? What type of income is it? What can be adjusted? What can't? And are we creating a situation where one spouse is carrying far more taxable income than what's necessary? That's the shift. You stop looking at retirement tax planning as a bunch of different pieces of the puzzle and start viewing it as the interconnected picture that it is. Because at the end of the day, the same amount of income does not always mean paying the same tax. And for retired couples, that matters. If you found this insightful, make sure to like the video and subscribe to the channel. We will keep breaking down retirement planning topics in plain English so you can make smarter decisions and simplify the complex. I'm Preston Pellegrini. Thanks for stopping by.